need to make some announcements. I have already posted those on the Google Classroom. Let me show you once again. Okay. So first thing is that next week we have 2 special lectures. You already must know. The first lecture is on agricultural commodity derivatives, which will take place on Monday first period from 10:30, and the second one will be on Wednesday 14th in the single period that we have on Wednesday. That will be on weather and energy derivatives. So have you all seen these things from the classroom?
Yes, sir.
Yeah. The next thing is I have posted the first assignment. The first assignment, which is due on 8th November, and the individual assignments and everything are in this Excel file. So have you also seen that one?
Yes, sir.
Yeah. Okay. So with that, let me now come back to our lecture material. And as we already had a discussion on Monday, did you look at the stochastic process background material yet? So I asked you to look at the stochastic process material like fast passage time, reflection principle, the distribution of maximum, things like that. What is the status on that? So I don't hear anything. Have any of you looked at this, the stochastic process background material?
Sir, I have gone through the notes of the MIT courseware.
Okay.
Right now, but I haven't consulted any books, so I will do it by this week.
Yeah, so that's good. That's a start. But I understand that most of you have not seen it yet. But that is going to be difficult because as we get into the material here and also for the continuous time model material, we will be using more and more of those concepts. So the sooner you start reading up, the better. All right. So anyway, let me continue with this because I wanted to discuss chapter 4 today. Are there any specific questions to chapter 4 that you want to ask me now before I begin? So what we have done so far, so let me do a quick recap on this. What we have done so far on chapter 4 is we have talked about the different option contracts which are available in the market, starting with the simple European and American call and put options. We have talked about this important result called put call parity, which helps us in pricing many of the contracts using other contracts. And then we have actually done some simple calculations on 2-period models, evaluating European and American call options to show when the American call option will be actually more expensive than an European call option. In general, we have the result that if I have no dividends and a constant interest rate, then European and American call option will coincide, which means American option will not be exercised early. Then we generalize to the principle of evaluating American options because it is complicated. I can evaluate, I can exercise it in all the intermediate time points. So it depends on the whole history. Remember the notation that we were using this notation. Where is it? Yeah, that European type options are basically dependent on the terminal stock price, but the American type depends on the whole history of the process, capital Y. That's why finding ZT is usually more complicated than finding VT. So what is the general principle that we are going to use? That principle uses a couple more concepts. One concept we discussed yesterday was about the super martingale, which is the particular stochastic process which is FT adapted and which has conditional expectation less than or equal to the current value. So it's an extension of the martingale idea on the less than or equal to side. Why is this relevant? We will see. We have also talked about a stopping time random variable and discussed a couple of examples. Why are stopping times relevant? Because when we are evaluating American options, we are looking at each possible time point where I might be exercising my option early. So these are called stopping times when the option is exercised. So we want to find out the probability distribution of this stopping time. That will help us in pricing the American. Ronak, can you mute yourself? Some noise is coming from your side. Okay. So a piece of notation, xi of st is the set of stopping times that take finite values in this interval s to t. So this is what I want to identify. And now suppose I have a risk neutral probability q. We have been using that all through. And now I define this adapted stochastic process capital Z defined for each time point 0 to capital T by this expression that I evaluate ZT as maximum over expectation of Y tau, where tau is one of the stopping times in the interval T to capital T. So the idea is the following. I start from a time point T and I look forward up to capital T and I identify all the possible stopping times. And at each stopping time, I evaluate this expectation. This expectation is nothing but the value of Y tau discounted to time T. So Y tau divided by B tau gives me the time 0 value. And then if I multiply it by BT, it gives me the time T value. So from tau, I go back to 0 and then I go forward to T again. So Y tau evaluated at time T, that is the expression. Conditional on the information available up to tau, of course. So this conditional expectation I maximize over all the possible stopping times. And this I define as my ZT. And now it is not very hard to understand that this ZT is one of our super martingales. Because if you are looking at ZT when T is increasing, you will see that the expectation cannot increase because I am maximizing over a smaller and smaller interval. So is this clear to all of you? ZT for increasing T is actually maximization over a smaller set. So it cannot be more. It has to be less than or equal. Is that clear?
Yes, sir.
So now, instead of looking at the undiscounted Z, I look at the discounted process Z by B, because discounted processes are easier to handle because they are all aligned with the same time point at time 0. So I say that the process Z by B is the smallest Q super martingale. So it's a super martingale with respect to the probability Q that satisfies Zt is greater than or equal to Vt for all t for all omega. So this is a result that requires careful exploration. We are not going into the details of that here, but the intuition is something that we can easily communicate. So VT is my European option. So for VT, there is no choice of exercise time. The exercise time is fixed at capital T. So my only possible stopping time is capital T. And based on that, I calculate an expected value, which is Vt at time t. Instead, for Z, I can actually maximize over a set which is more than a singleton, the set of all the xi tt. So Zt will be always greater than or equal to Vt. This much we know. And essentially, what we are interested in is at which point Zt becomes equal to Vt. So Zt must be more than Vt in general, but when it becomes equal to Vt, that is when our actual early exercise question will come in. So what is my stopping time for the American option? The stopping time for my American option is tau of t. So starting from t, I find the stopping time tau, which is what? Which is the first time after t that Zs becomes equal to Ys. So it is the first time when Zs equals Ys, which means from t up to s, it was always greater than or equal to, or so in some cases it might be strictly greater. So S is the first time when the actual equality occurs. And remember, it is always greater than or equal to. So which means up to but just before S, it was strictly more. This is the minimum. So this is the first time it becomes equal. So before that, it was strictly greater. So this stopping time actually will maximize my expectation expression here. This will maximize my expectation expression here, because then I am coming with the value of the American option is coming from above, strictly above the European option value. And how do we calculate this? Start from any time 0, and there are many steps up to capital T. The whole computation will be very, very complex. So usually these problems are all solved by a process called backward induction, which is what I actually start at the end, because in the end there is very, very little uncertainty left. So if I just arrive at time period t minus 1, only one period to go, then very little can change, and the calculations are only on a single time step, so it will be very easy to do. So at time t minus 1, the only decision I can take is whether I execute immediately or I wait for the next day, which is the last day. And I solve the t minus 1 time problem. Then I go one step backwards, I solve the t minus 2 time problem, because now all the solutions for the t minus 1 time nodes are available to me. So with that information, I solve the t minus 2 time point problem, and so on backwards till I reach the current time. So this is the backward induction principle, and the method that is used is called dynamic programming. So dynamic programming is essentially a time-dependent objective optimization problem, and our variable of interest, so let me call it variable, I will explain why. Our variable of interest is essentially when I should be exercising. what is my stopping time? So any such optimization problem which spans over time interval is a dynamic programming problem, and usually they are always solved by working backwards using the backward induction principle. Is this clear? Because dynamic programming may not be familiar to you, so I'm not going into any details, but just giving you the conceptual idea. So is this clear? Can you tell me if the backward induction process is clear, at least intuitively?
Yes, sir.
Yes, sir.
Okay, thank you. So dynamic programming I will not use explicitly, so you need not go through the theory, but if you are curious you can always look it up, because it's a very powerful optimization tool. I know that you are familiar with all the typical calculus type of optimization or even linear programming in the discrete domain, but they are all static optimization problems. Everything is one shot, there is no time concept. Dynamic programming is the next level, where you are looking at an optimization problem spanning over a time interval. There are many steps, and at each step you have to take decisions. And those problems are extremely common in many of the financial models. When you want to study financial models, most of the time you are looking at a time dependent problem. And most of the time your optimization concept will be the dynamic program. That will be your tool. So if you are interested, I can share some references later on, but this is not going to be a part of this syllabus. All right. So once again, my objective is to identify the stopping times for a super martingale, which in our context is the value process for the American option. And these stopping times are when I will exercise. These are the exercise time points. How do I evaluate my objective? I evaluate my objective using this backward induction principle. I start from the last point and work backwards, because that's how it becomes easier to handle. Okay. So what is the result that I finally have? So this is one result, that if I have the risk neutral probability, the process Z, as in equation 4.7, this expectation, conditional expectation maximization problem. So let me try and keep both things together. Yeah. So this is my Z in 4.7 up here. So the process Z as in 4.7 and the American option is marketable. So of course I need marketability, otherwise I do not have replicating portfolio and all that, and I cannot price things. Then if these conditions are met, then Z is the value of the price process for the option. Z will actually give me the value of the price process after optimization. And the optimal early exercise strategy is what? It is the set of stopping time starting from time zero. Set of stopping time starting from time zero when the option is born. And how is that evaluated? That is given by this equation 4.9, where I put t equal to 0. So basically I look at the complete lifetime of the option 0 to capital T. I solve for tau 0. So that gives me the solution to the stopping time problem. Now, we have already seen situations where we do not exercise early. We have seen an example like that. So what does it mean in this notation? In this notation, the same result can be restated, that if I have a constant interest rate and no dividends, then my tau 0 will be equal to capital, which means my stopping time is at the expense. I do not exercise it before. So if tau 0 is equal to capital T, that means American is same as European, so the prices will also be the same. But we have also seen another example where optimal exercise was early in some of the omegas. So there we know that tau 0 is not capital T, but strictly less than. All right. Is this okay? So that is the option valuation primer. I call it primer because I have only talked about very simple examples and I have given you the general principle. But when you are faced with real life big binomial models with lot of steps, you will have to really write a program which operationalizes the dynamic programming algorithm. Of course, such things are now ready-made, available on the net. The one I showed you earlier, that Hoadley website, that calculates all the option prices for you. So after this point, you should go back to that website and try out different combinations to see how it works, how American options are evaluated using the binomial tree method. So I move on to a couple more other things, because when I showed you the slides from Hull, I not only talked about options, but we also talked about things like forwards and futures contract as well as swaps. So let me talk about a little bit about them. Options are the most interesting objects, so you have spent some time with options, but forward contracts, futures contracts are also very, very popular, particularly when you come to the commodity derivatives market in India. You will see that options are not allowed on many things, but forward contracts are allowed. In fact, for agricultural commodities, when next week we have the lecture, you will see that it will talk about futures contract, forward contracts, which I will define, but it will not talk about options, because options have not yet really come into the agricultural commodity market, at least in our country. So in order to understand those contracts, we will need to first look at a couple of definitions. The definitions are regarding how to evaluate a stream of payments. So think of a stream of payments, we call it a cash stream. A cash stream is like this. From time t, I look at all the future payments. Future payments can happen at t plus 1, t plus 2 up to capital T. So I have a finite horizon where I will stop. Suppose these payments are denoted by delta D. So what is the value of this stream of payments to me now at time t? At time t, what is the value of them? So that valuation is called a time t present value. So this is called the present value calculation. And how is the present value calculated? Of course, I am standing at time t. So all my information is up to time t. So it is script ft. So that is my information set. So whatever expectation I want to evaluate, it will be conditional on current information. So what am I calculating? I am calculating the expected value of this payment at time s. Payment at time s, but evaluated at time t. So I divide it by bs and multiply by bt, which means the valuation is done as on time t. And this can happen for s equal to t plus 1 to capital T. So I sum over all the time points. This will be capital T, by the way, not tau. So if I am looking at a cash stream from t plus 1 to capital T, then the time t present value is sum over all these expected payments evaluated at time t, the present value concept. And there might be uncertainty involved to those cash payments. So I take expectation conditional on whatever information I have now. So conditioning on my current information, I calculate the conditional expectations and sum them up. So what am I doing? I am thinking of a time s payment. That time s payment, suppose it is 1 rupees. How much is it? How much is its value to me now at time t? Because if I get 1 rupee tomorrow, that is not the same as getting 1 rupee today. 1 rupee tomorrow is actually same as 1 by 1 plus r rupee today. Because if I get that much, I can put it in the bank. Tomorrow I will get 1 rupee. So that is why this discounting has to be done to bring everything to a time t valuation. So delta ds divided by ds brings it to the time 0 valuation. So that is equivalent to whatever the value would be at time 0. But then I will again put it in the bank and it will grow up to time t. And how much is the growth? That growth will be given by bt. So that is why the valuation of the cash payment at time s to be evaluated at time t will be given by this expression. So the actual payment, and then this is the appropriate discounting. And here I am allowing for random bank rates also. So the expectation is over both the cash payment as well as the bank rate. If the bank rates are non-stochastic, then I will just take them outside the expectation. In fact, in particular, the case that we have been using most, a constant rate of interest, then I will take this everything out and it will just be r to the power t minus s. It will be, 1 plus r to the power t minus s. Okay, is that clear? The present value of a cash stream, is this clear? Because for all our calculation purpose, this is the quantity that we should be using. Because our payments might be at different time points, we want to compare them from one particular time point. Is this okay?
Yes, sir.
All right. Okay. So I know how to do this present value calculation. This is what we are learning. So with that present value calculation, now let me define the forward price. So suppose I am looking at a security S, some stock. Now this stock currently is valued at S small t. Now is time small t and the value of the stock is time st. What is the forward price of this stock if I hold on to it for time up to, say, capital tau? So what should I expect? I have a stock now. I want to hold on to it for some time. What is the valuation of that? Now we already know that under the risk neutral probability, our stock, our discounted stock price does not change. So S star, delta S star n is 0. Expectation of delta S star n is 0. That we have already seen. Which means under risk neutral probability, we expect the stock to grow only at the bank rate. So if I want to calculate forward prices, all I need to do is multiply the stock price with the appropriate bank rate. And this is done here. So if I look at the forward price and I call it O of t, then it will be the actual stock price. And then I divide by this particular quantity. If you look at it carefully, it is the bank rate applicable to the time period between small t and time period tau. So this is from t to tau. I divide it here. I can also write it in a multiplicative manner here. So again, I am allowing for stochastic interest rates. So I am using expectation here. If they are non-stochastic, then it will be just a multiplicative formula. So this formula is same as this formula here, the same principle. So is this clear to all of you? How do I value something at a future time point?
Sir, what is tau here in this definition?
Tau is the time point where I want to see the evaluation.
Okay, that's anything between t and capital T.
That is somewhere between t and capital T.
Okay, okay.
And suppose I have a stock, but I also know that some dividends will be paid out of that stock through that lifetime. Even then I can do the evaluation. So if I have dividends, then I will take this expression, which is the expression here, but I will deduct all the dividend payments, but evaluated at present. So I will deduct the present value of all the dividend payments. Dividend payments are like a cash stream. So that cash stream is evaluated and I deduct it from the original price. So that's why this notation delta D was given here. So basically the most common example of cash streams are dividends, and dividends are taken out of the stock price that we have discussed already. So if I want to look at forward prices, future price of a stock, which is going to give you dividends, then I need to deduct it from here. And then the final expression will be like this. And again, the expressions will become much simpler if you have a non-stochastic interest rate. All those B expressions will come out of the expectation and a lot of cancellations will happen. It would be much easier. Okay. So these are the expressions that we normally think about when we are thinking of stocks, because stocks are like paper, or they are now electronic, not even paper. So I really don't need to worry about how to store them, how to keep them fresh or anything like that. Those things don't make any sense. So all I need to think about is the money value of the stock. But suppose I am thinking of commodities, actual physical commodities, metal or agricultural produce, then I have some additional considerations to think of. And these additional considerations are all to do with the actual physical characteristics of the product. If they are agricultural products, I need to keep them refrigerated so that they are fresh, or maybe some preservatives or whatever. If they are metals, they must be stored. So large warehouse space have to be rented, and it has to be dry so that it doesn't rust. So all physical characteristics will actually add on to my pricing or valuation considerations. So when we are talking about physical commodities and their forward contracts, we also need to keep in mind that we have to think of these costs, which are called carrying costs or inventory cost. So carrying cost or inventory cost are very important considerations whenever you are working in the market of physical commodities. Maybe the physical commodity is not with you now. You have a futures contract or you have an option, but still those physical characteristics will impact on the valuation of the contract. Does it make sense? Whatever we are saying, does it make sense? Carrying cost?
Yes, sir.
Okay, so we have this present value calculation and the forward price formula. So why do we need it? So the second most important contract after options that we see in the financial market is the forward contract. So a forward contract is similar to the option contract in the sense that I contract a fixed price for a fixed amount of a commodity or asset today, but the transaction will take place in the future. So for example, if I contract with you that I will buy 1 quintal of steel from you at 22,000 rupees on 31st December, that is a forward contract. So I will make the payment and take the delivery on 31st December, but the price and quantity and everything is fixed today. And the difference with option is the following, that this contract is mandatory to exercise on both parties. So there is no right. So in option, I can choose not to exercise. I have the right, but not the obligation. But a forward contract is obligation. both parties must meet the contract on 31st December. One party must bring the money, the other party must bring the skill. So these kind of contracts are called forward contracts. They are relatively easier to price because there is no question of probability calculations there, because you are going to exercise it. So what you do is you calculate the unconditional expectation on time t, and based on that you find your price. Of course, it's the same risk neutral valuation principle. So your conditional expectation or whatever will be calculated on the risk neutral price. So that for that thing, these are the kind of formula that comes into play. So this forward price calculations are exactly what is used for pricing a forward contract. And there are many forward contracts available in the stock markets. When you go to the stock market, you will have a lot of ready-made forward contracts. These are called futures. So futures are like ready-made forward contracts which are traded on organized stock exchanges. You can also write a forward contract as you like with some other person, like customize it as you want, but that would happen only for very big value transactions. For all usual requirements, you will just go to the stock market. So it's like, the menu of options that we showed you earlier, there is also a menu of forward contracts, ready-made forward contracts, and they are called futures. In fact, earlier when we showed you the stock market websites, there were many forward contracts, futures listed there. So futures contracts on stock index, futures contracts on commodities, futures contract on energy, all of these things are now available and actively traded in the stock market. And the pricing will happen according to this formula, but for physical commodities, the carrying cost considerations will also have to be put in here. So I'm not giving those details because that might get very complicated, because it depends on the physical characteristics of the commodity. But you can easily understand intuitively that the price will not be something as simple as this. I have to take into consideration all these other physical things, carrying cost or inventory cost or whatever. But right now, the question that is important for us is the following, that we have already shown that the market is an efficient, smart kind of market if there is a risk neutral probability, unique risk neutral probability, under which all the discounted stock price changes are martingales. Translated to the market language, under the risk neutral probability, all the stocks are expected to grow only at the bank rate. So I would expect the stock to give me only as much as the bank in expectation. And under that, I have a description of a complete market. So all stocks have the same property, and all contracts are achievable. All types of contracts are marketable. We have seen this result before, right? Is this clear to all of you? Remember all this thing? The complete market description, is that okay?
Yes, sir.
So now what will happen if I put in these futures contracts in the market also? So basically what I have done is I have extended my portfolio of stocks. I had the original stocks, but I also allow people to trade in the futures contracts. So there are some more assets coming in. So these assets are not fundamental assets because they are only written on the stocks, but they are new contracts which are available for trading. So it is like the dimension of my space has been extended. So in terms of our notation, what is happening here? We are saying that forward contracts traded in organized stock exchanges are inserted in the securities market. So originally I had the capital N many stocks, and suppose now I have capital J many futures contract available in the market. I just make them available, a large number. capital J may be a large number. So what can I say about this new market? This new market is bigger. It has all the stocks as well as these new futures contracts. This is an important result, which is an extension of the earlier result, that suppose the bank process is predictable, so this is something that we have always assumed, then there does not exist arbitrage opportunity in the multi-period futures market. So remember, we are now talking about the bigger market, which includes the futures also. So there is no arbitrage opportunity in the multi-period futures market if and only if the same condition holds for both the discounted stocks as well as the futures contracts. If and only if there exists a Q such that Sn star for all n and each of these uses for 1 to capital J are martingales under Q. Just one moment. Okay, sorry about that. So this is the new result, which is just an extension of the earlier result involving only the stocks. So we are saying that our market will be as efficient as before, a complete smart market, no arbitrage opportunities, even with the futures, if I have the Q satisfying both the set of martingale conditions, one set for the stocks and another set for the futures. So basically, if I think of our payoff matrix as before, now the payoff matrix has become bigger. There are more assets, but still the same condition holds. Is this clear? In the earlier payoff matrix discussion, we had a rank condition for completeness. A similar rank condition has to hold here. So do you all recall the earlier result, and can you connect it with this one? Because if you want, I can scroll back and show you. So we had this complete market discussion in the last chapter. So let me just go back. So if you recall this is in chapter 2 that we discussed earlier in terms of our stocks only. So we had this completeness result. The market is complete if and only if this rank condition. So what I am now saying is a similar result, but with the extended market description, which includes my futures contracts. So does it sound meaningful now?
Yes, sir.
So again, these results require careful proofs, but because we have already looked at one proof, I am not going into details, but similar intuition also holds here. The proof will happen similarly. It will go through similarly. So before I conclude, let me give you the third contract description. So we have talked about options quite a bit. We have talked about the forward contract now a little bit. There is a third type, which I also showed you some slides on Monday, which are called swap contracts. Swap contracts are exchange arrangements. So what do I do? Suppose I have a stock which gives me some uncertain return over the years. I don't know exactly how much, but there is a probability distribution. So I come to you. I come to you and say that, okay, I don't like this uncertainty. I want a fixed return. So if I give you the returns I get from my stock for the next 1 year, so whatever return I get every month, I will pay you that. That's an uncertain thing. It's a random variable. In return, you pay me a fixed rate, maybe 7% rate. So I offer you my variable return, you give me a fixed return. This is a swap contract. And then we will negotiate a correct price for this swap contract. Again, we will use the law of one price. We will calculate risk neutral expectations. And what will happen? Once we have written the contract for the next 1 year, whatever returns I get on my stock, I will give you, and you will give me 7% at every month. The same kind of swap arrangement can happen in terms of volatility also. That's the example that I showed you on Monday, a variance and volatility swap. So basically, you quantify the uncertainty in your asset, call it volatility. You can use variance, you can use some other measure, doesn't matter. And that is something that is going to change over the lifetime of the stock. You don't like it. You want a fixed amount of uncertainty, fixed amount of volatility. That also you can achieve through a swap contract. So you give your variable volatility to someone and take a fixed amount of volatility in return, and you negotiate the correct price. So basically, in the financial market, these are the three pillars, the three basis contracts: options, futures, and swaps. And using them in various combinations, you can create a very rich variety of contracts. And I have shown you some of them in the slides from Hall, but there are many, many more. But if you can understand the basic principles and know how to evaluate such contracts, then you can handle any complicated question. All right. So there are two things that I need you to do, actually three things. And all three are important. The first thing is that you have to read up the stochastic process background material. Those of you who did not have a background, this is a must. Because next week onwards, we are going to talk about the continuous time models. And in continuous time models, the stochastic process properties will be used more explicitly. So I will basically assume some of the properties, I will assume that you know them and use them in the further developments in our particular context. I will keep things intuitive, I will keep things relatively informal, but conceptual clarity must be there. You conceptually must know what I am talking about. So that is one thing that I need you to do. The second thing is, now look at different examples of these contracts. Look at Hall's book or look at this website that I showed you. See how the calculations happen. You don't have to do them manually, but you should know what are the considerations that are relevant for these calculations. And in the process, you will understand that these all require those stopping time concept, reflection principle, the maximum value distribution. All of those things are actually relevant when you are numerically evaluating options, particularly American type options, because you have to evaluate throughout the history. And the third thing is the exercises and examples that I have been asking you to do from all these chapters so far, because this is the end of the discrete time models. So from next week, we will start on the continuous time model along with the special lectures. So Monday, I will have one lecture after the special one. The second one I will take. Wednesday, there will be just a special lecture, and then so on. So from chapter 4, the examples that I want you to study are 4.1 up to 4.4, 4.6 and 4.7. You can see them at the bottom of the screen here. And the exercises I want you to do are 4.1 to 4.4, 4.7 to 4.9, and 4.11, 4.14. Okay, all of you can see this thing. This is visible.
Yes, sir.
Yeah, just a second. Okay, so these are the exercises and examples I want you to study. They involve options as well as forward contracts, so you will get a flavor of how the calculations go. But that was the third item that I mentioned. For all the 4 chapters, I have given you exercises and examples, so I want you to now start working on them. Because this is like the first installment of the course, the discrete time models. We will discuss problems and clarifications later on also, but the theory part in the discrete time model is done. Next, I will go on to the continuous time models, and I will then focus on that. So if you are unclear about the discrete time model details and have not done the exercises, then it will keep piling up, and in the end, it will become difficult. So don't let it pile up. Start working. Do it slowly, but do it regularly. Okay. So any questions, anyone? So I will stop today unless you have any questions now. And do start studying and do ask me questions, because otherwise things are going to be piled up, and later on it will be much harder to go through. It is easy if you do it quickly. Yeah, so Vinamdon wants the optimization problem details. So, okay, so that I will give you offline. Anything related directly to the chapter 1 to chapter 4 material, that's what I am asking now. Okay, so I guess that's it for today.